And what I think a lot of people need to remember is that the change in credit costs now in the past year through the fourth quarter, for a lot of banks, it's equal to over 80% in the change of net interest income. So everybody was hoping and waiting for these banks to report very strong core earnings, but a lot of it is being wiped away by rising credit costs. And what it really says to us is that these banks are fairly worried about the future. They're seeing 30-day past due loans rising. They're seeing 90-day past due loans rising, and they're a little bit worried. So they're replenishing their loan loss reserves, which they've been running down for a long time. And finally, they have to start boosting those.
Yeah, and what we see is these, higher borrowing costs off the back of the Fed hikes, making easy money for the banks like car loans and mortgages much harder to come by. And at the same time, of course, making deposits more expensive for the banks as well. So if you look at this from a macro perspective, when you see these banks talking about the impact of a possible coming recession, where ultimately do you expect to see rates landing in the United States? Because that will basically determine the outlook for the majors.
Well, I'm not so sure it's about a certain level of rates. I think we have to look at the incremental change in rates. And I think most people would agree that we're very, very close to the end of the rising interest rate cycle. And if that's true, that's an important point. But what I think people need to remember is that banks' funding costs are rising hugely, in some cases 500 or 600% growth in the fourth quarter year on year, where interest income might be rising 90 or 100%. Still very good, but there's often a lag on funding costs. And this is where people can be caught out during this year with rising credit costs, worsening net interest margins, or at least no longer any expansion. But what we didn't talk about is sharply decelerating loan volume.
Indeed, and that is a major issue. And to counter some of this weakness, we've also seen the big banks undertaking a cost-out process. We've seen job cuts, we've seen adjustments being made to banking bonuses, for example, trying to mitigate some of the weakness that they're seeing in deal book activity and, of course, just general banking activity as well. Trading activity, you could probably add to that too. So have we seen the worst of that cost out in this quarter, or would you expect further costs to be cut over coming weeks as the banks deal with macro headwinds and weakness?
I do not think the worst is over, no. We've looked, and anybody can see the data on, for instance, employees or technology and communication costs. These numbers are much higher generally than they were, say, 3 years ago at the end of 2019. And yet profit is not much higher. It's marginally higher. The two banks that will announce this week, Morgan Stanley and Goldman Sachs, there have been huge increases in the number of employees over the past 2.5 years. And we have heard Goldman's in particular talking about major layoffs. And it actually makes sense from an economic standpoint. But I don't think that this is now finished. It's probably beginning, and there should be more of it coming through in coming weeks.
So what should we expect to see